Welcome to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week on the podcast, my guests are Jamie and Patrick Furlong. Jamie and Patrick specialize in 1031 exchanges and Delaware Statutory Trusts, which are both very useful financial planning tools if you're someone who invests in real estate or other income-producing assets. You want to sell them, but you don't want to pay the taxes. This nifty little maneuver enables you to defer taxes and kick that can down the road indefinitely. We had a really good conversation of how this works, and I learned a lot specifically about Delaware Statutory Trusts and how they can fit into this picture. Now, the way Jamie and Patrick are set up, they're in the financial industry as well and have their own compliance requirements. So just as I have a disclosure on the podcast, they have their own disclosure, which I will play for you now. I hope you enjoy the episode.
Information discussed is for informational purposes only, does not constitute individual investment advice, and should not be relied upon as tax or legal advice. Please consult the appropriate professional regarding your individual circumstance. Real estate securities are speculative and carry multiple associated risks, including illiquidity and the potential loss of the entire investment. Returns are not guaranteed and have the potential to be lower than anticipated. Past performance and forecasts do not guarantee future results. Legacy Investment Real Estate LLC offers securities through Concord Investment Services, member FINRA SIPC, and our firm is independent from Concord Investment Services.
Hey, everybody. Real quick before we jump into today's episode, I have been advised by my attorneys to remind you all that none of what you might hear in today or any other episode of Grow Money Business is financial, investing, tax, legal, fitness, or even relationship advice. It's content that you're free to use and deploy on your own terms. And before you take any actions on what we might cover in the show, I really encourage you to consult with your accountant, attorney, or financial planner. If you don't have a financial planner and think that you might need one, be sure to check out threeoakswealth.com to learn more about my firm's planning, advice, and investment services. Jamie and Patrick, welcome to the podcast. Thank you for joining me today.
Our pleasure.
Thank you so much.
You two have the distinct, I don't know if I'd call it an honor or not, but you're the first guests we've had where two people are recording in the same room from a location other than my office. It's the first time we've done that. So you sound great. I'm excited to have you on.
Well, we're in orbit. No, I mean, the technology today is wonderful and it makes us so much more productive, right? And we even save the environment a little bit. I mean, think all the carbon we didn't emit driving over to your office.
That's true. That's true. I didn't tell you this, but the electricity in my office is produced by a coal machine that sits out in the parking lot, but we can ignore that for the time being.
Is that what all that smoke's coming from?
Yeah.
Okay.
So tell us a little bit about your business and what you two do in your day job right now.
I'll let Patrick answer that question. And Patrick's my father. I'm his daughter. And he is the one who got me into this business. And I think the origin story illuminates a lot about why we do what we do. So Patrick, I'll let you
Thank you,
take that one.
So I was in commercial real estate finance for many years, worked for a lot of different banks and financed commercial real estate, basically. In 2009, I was with Wachovia Bank, which cratered and got laid off. And fortunately, all my kids were out of college and everything. So I had some flexibility in terms of what my next steps were going to be. Decided I didn't want to work for anybody. And so I went to work for a Sperry Van Ness commercial real estate office in Fresno and just started doing what commercial real estate brokers do. Leases, buying, selling, representing clients, and things like that. I was referred a client who had sold a farm and wanted to do a 1031 exchange. So this was kind of my first experience with somebody that wanted to do a 1031 exchange. What I did was I looked at a lot of different types of properties for them all over the country. What they decided to do, because they didn't want a property that they had to manage, they decided to buy what's called an absolute triple net lease, which means that the client just collects a check from the tenant, and the tenants are generally credit tenants. In this case, it was an Applebee's franchisee that owned about 30 Applebee's. So that sort of tipped me off that there might be more farmers out there who are selling farms for large amounts of money that would like to exchange and would like to exchange into properties that had a little management, because that was kind of the developing that profile. So I did that for a few more years and worked with a number of different farmers and ranchers, and primarily found them single tenant properties, everything from Walgreens to Walmarts to McDonald's, you name it. In 2016, I had a client who basically told me about DSTs. I'd not known about them before. So I looked
DSTs
into,
meaning Delaware
I'm sorry, the
Statutory
Delaware
Trusts, right?
Statutory Trust, right. And when I looked at what the Delaware Statutory Trusts were and what the benefits that they would offer my clients, because I was really beginning to focus then on clients in an exchange. I decided I didn't want to chase leasing deals. I didn't really want to rep sellers. I found, and in the interim, I had moved up to Seattle for a while and worked for Marcus and Millichap up there. They're the leading investment real estate firm in the country. Um, then I came back to California. But anyway, when I learned about the DSTs, I thought this is perfect because sometimes I might have a client that has $4 million. I sell them something that's $3.5 million. Now they have $500,000 in boot. What are we going to do? So I could weave a DST into that deal, and they would end up with no boot. I had to get a securities license to do that because you have to have securities licenses to sell Delaware Statutory Trust. So in 2017, I got my securities license and started to market myself both as a real estate broker and as someone that offered Delaware Statutory Trust.
May I interrupt for just a moment,
Sure.
Patrick? And that background is exactly what I was asking for. And I just want to take a moment and back up, because the example you just gave, I don't want to throw out too much jargon out there for our listeners without kind of going through this piece by piece. So you had a client with a $4 million property that they were trying to sell. And if you sell the property and you don't do anything else with it through a 1031 exchange, you're going to pay capital gains taxes on that sale, right? And so what
You'll
I heard you
pay.
say, sorry, go ahead.
Well, I was going to say you're going to pay a federal tax. Most states have state income tax. You're going to pay a state income tax, and then you're going to pay what's called the Obamacare tax. So generally, we figure about 30% of the proceeds are going to go to the government in one
Right,
shape or another.
right.
So with a 1031 exchange, you can, if you sell a farm, you can exchange into any other kind of income property. It could be an apartment, could be cell towers, anything that's an investment type of property. It could be industrial properties, whatever. So like for like just means investment property for investment property.
But if the property you're swapping into, you have a $4 million piece of land or property you're selling, you swap it into a $3.5 million piece of property, you've got $500,000 left over that's going to be subject to that 30% more or less taxation, right?
That's
And
correct.
that's what you mean by boot, I take it, right? That's the industry term for amount left over subject to taxation.
Yes, and that boot can be either equity, equity or cash boot. It could also be debt boot, because when you do a 1031 exchange, you have to replace not only the cash you get out of the deal, but whatever the debt was in the deal. So you could end up with both equity boot and debt boot. And that's where the magic of the DST comes in. And I think I'm going to let Jamie kind of take over from here.
Sure. So, Grant, you're a great sort of case study. What Patrick and I do, we go out networking or we go to dinner parties, and people always ask what you do, and it's a hard question to answer because where do you start? Does the person asking understand investment real estate? Does the person asking understand 1031 exchanges? Does the person asking understand what a Delaware Statutory Trust is? So I'm going to let you go ahead and ask whatever question based on where we're sort of at in the understanding right now.
Well, let me frame this a little bit. I think so. A lot of our clients at the financial planning firm, a lot of our listeners are business owners. And one thing that I'm keen on that a lot of our clients have done is purchase the building in which their business operates. Great wealth building tool. We've had real estate experts come on and kind of describe how that works. You as the building owner, you lease the space to your business in an arm's length transaction. It's this nice wealth builder, but the 1031 exchange as a tool for deferring taxes is not something we've covered a whole lot. So I think our listeners are understanding of what it is in general, but these technical terms, boot, how the Delaware Statutory Trust comes into that, not something that we've covered at all. So if you're, why don't you take it from there and explain where the Delaware Statutory Trust comes in?
Perfect. So let's take that sample client, someone who owns the business, owns the property that's housed their business, and now they're retiring. The wonderful thing about a 1031 exchange is that it means your real estate investments can evolve as your life changes, because you can swap what you currently own for another investment property that better suits your lifestyle and needs at that point in time. So this retiree no longer works in the property that they own, and they probably have a new tenant, and they're wondering if perhaps there's another property that is better for them at this point in time. And the 1031 exchange would allow them to put that property on the market, list it with a broker, and then open a 1031 exchange with a qualified intermediary. So that is a service we don't provide, but there's a lot of reputable qualified intermediaries available to our clients. And then they work with someone like us to strategize where should they reinvest their money. And topics we're going to cover are what are their risk profile? What is their lifestyle? Do they want to be managing a property? Do they not want to be managing a property? What are their income needs? We're going to talk about estate planning and how they want to pass on their assets to their beneficiaries. The long-term goal for most of our clients is to always keep their money in consecutive real estate investment properties so that they can potentially defer the taxes forever, right? Current tax law allows many investors who own investment real estate, when they pass away, to pass on the property at a fair market value or a step up in basis to their heirs. So if your client sells this office property today and doesn't do a 1031 exchange, they have a large tax bill, and then they still have to invest their remaining capital somewhere. Or if they 1031 exchange into something like a Delaware Statutory Trust, they can defer the taxes potentially forever. They still own real estate, so they've got diversification to their stock portfolio. They're potentially earning an income. And when they pass away, the value of that Delaware Statutory Trust can get appraised at fair market value, passed on to the heirs at the fair market value pursuant to tax law at that time. And now their children can conceivably sell those assets or not do another 1031 exchange when the property sells, and they don't have the tax liability that the parents had if the parents had sold today. So the Delaware Statutory Trust can be the last piece of someone's real estate investment timeline where they're looking to continue to defer taxes, potentially generate income and the other benefits that come along with real estate investments, like tax deductions, depreciation, and potentially appreciation.
Gotcha. Patrick, go ahead.
Well, Grant, I was going to say maybe it's time to talk about what a Delaware statutory trust is. So, Delaware Statutory Trust is really a legal structure. You have corporations, sub S corporations, LLCs, partnerships. So, a Delaware Statutory Trust is a legal structure. The IRS has approved only Delaware Statutory Trust as things that, well, you can also do it with uh, tenant in common, but that's got a whole can of worms to it. So Delaware Statutory Trust, you can exchange into and exchange out of. You can't do that with a real estate investment trust. So only a Delaware Statutory Trust can you exchange into and out of, keeping title as it originally was. So if you sold a property as ABC Incorporated, whatever you buy has to be bought as ABC Incorporated. So the Delaware Statutory Trust allows you to exchange in, and then when the property or properties in the Delaware Statutory Trust are sold, you can exchange again. Unlike a REIT, you could go into some partnership. You couldn't go into a partnership, but you could go into a tenant in common, because if you go into a partnership, you're not buying ABC Incorporated, you're buying XYZ partnership. So that would not work. Um, so that's what makes the Delaware Statutory Trust unique, and that's approved by the IRS.
So just to go back to our example to lay things out really clearly for everyone, you've got a $4 million property. You're going to sell it and use the cash and buy another $3.5 million property that better suits your needs at the time. You've got $500,000 left over. That can go into a Delaware statutory trust. And the reason that we're going through this whole exercise is because if you do these like-kind exchanges, you kick that tax can down the road while the value of your properties is hopefully or probably going up over time. And if you continue kicking that tax can down the road until you die, then your beneficiaries inherit it and you never pay tax on those gains, which is a really nice multi-generational feature. So what kind of stuff can you put inside a Delaware statutory trust, and why would you not do out of a $4 million property, a 1031 or two 1031s, I guess, one into the $3.5 million property, a second one into the $500,000 property? What is the benefit of the trust?
Our job would be to meet the client and help them understand how they might diversify their proceeds, and whether or not that might be diversifying all their proceeds into different DST properties, or if we might incorporate more traditional assets like a Walgreens or another single family rental. So you can do any combination of this. If you have $4 million, you might put all 4 million into DSTs. And Patrick and I will work with the client to help them understand the different options and how they might reinvest this $4 million. Within a DST, you can conceivably find any kind of real property. But what you're going to find on a given day is real estate investments that make sense for that market and where we are in the real estate cycle. And generally speaking, what Patrick and I want to see in what kind of properties we want to see in a Delaware statutory trust are properties where we believe our clients have the right risk return ratio, properties that we believe will perform according to the performas, and have a high degree of confidence that our clients are going to get income as projected, and be invested in a property that has the potential to preserve or grow their equity.
Can you help me understand why one puts a property into a Delaware statutory trust in the first place?
So that's a good question, Grant, and kind of leads into how the whole Delaware Statutory Trust industry, so to speak, works. So the way it works is you'll have what we call a sponsor company. Now, there's lots of sponsors of Delaware Statutory Trust. There's only about 10 that we work with because they've been around for years and years and years and years, and they have a proven track record. And every Delaware Statutory Trust, every deal has an SEC regulated private placement memorandum where everything you want to know about the property and the sponsor are in there. So the way it works, you might have a company like, are you familiar with Cantor Fitzgerald?
Mm-hmm.
Okay, so Cantor Fitzgerald does, one of the largest real estate owner manager companies in the world. I mean, they have properties all over the world. They own Newmark Grubb, the brokerage. There's no bigger, better organization. So Cantor Fitzgerald has a DST division. So they'll go out and they will buy, let's say, a $50 million Class A apartment in Dallas, Texas. They put it into the Delaware Statutory Trust. They pay cash for it. They put it into the Delaware Statutory Trust. Usually they'll go out and get a loan for about 50% of that. So if it's a $50 million property, you've got $25 million worth of equity. You've got $25 million worth of debt. That's important because a lot of clients will have to replace debt. In this case, that debt, if they invest in that DST, they don't have to apply for that loan, and it's non-recourse. So if something happened, they're not responsible to pay it back. So the Delaware Statutory Trust is a ready-to-go vehicle. We may at any one time have about 12 deals on our platform from companies like Cantor Fitzgerald, companies like Blue Rock, Black Creek, Jones Lang LaSalle, the best of the best. And again, there may be 30 or 40 companies out there that do DSTs, but we work with only the best. So the way the process works, the sponsor then comes to our broker dealer, Concord Investment Services, and they say, we would like you to sell our DST through your network of registered representatives like Jamie and I. And so Concord does their due diligence. If it doesn't pass their due diligence, we never see it. When it gets to Jamie and me, we do our due diligence. I'm a real estate broker. In addition to, I have my securities licenses. Jamie's just completing her CCIM. We have unparalleled tools compared to anybody that does what we do in this space to analyze every real estate deal. So somebody might come to us and we may, when, like Jamie says, we go through the process of finding out what their risk tolerance is, what their lifestyle is going to be, and then we talk about the pros and cons of owning the real estate outright, where they own 100% of it themselves, and we talk about the benefits of a Delaware Statutory Trust or a number of Delaware Statutory Trusts. So then we get the kind of the client profile, and then we start making presentations, in terms of they may think they'd like to buy, let's say in the case of somebody has $4 million, maybe they would like to buy a single tenant property. Let's just say, for example, an advanced auto. So I do I have about 700 brokers around the country that I work with that specialize in single tenant properties. I send out an email. This is what I'm looking for. I get all kinds of emails back. I start working through those. We might be looking at DSTs concurrently. Jamie might be looking at DSTs. So we're doing a lot of work to kind of bring to our client what makes sense given their profile.
So is it safe to say then, and I'm using our example kind of as a baseline here, you've got $3.5 million that you've got a $4 million property, 3.5 of it's going to go into like the office building down the street via a 1031 exchange. If you do that, you're going to be responsible for managing the property, paying unless it's a triple net lease like you described earlier. You're paying the property taxes, you're doing all the maintenance, you're doing the landscaping, air conditioning goes out, you're fixing that. The $500,000 left over, you still don't want to pay tax on. And so the Delaware Statutory Trust is not where you take the $500,000, go buy a single family home and title it inside of a Delaware Statutory Trust. It's a larger real estate investment that's been securitized in a way that preserves that tax deferral. Is that a
Yeah.
fair summary?
Yes. And as an example, there's Delaware Statutory Trusts that own Amazon distribution centers. That might be $100 million deal. So people can, if that's available, people can take as little as $100,000 and put it into owning part of a Amazon distribution center. Could be a life science building. Could be a Pfizer manufacturing facility. Could be anything like that. There's some requirements to meet the criteria to be a Delaware Statutory Trust, to meet all the IRS regulations. We won't go into that because that's all kind of taken care of. But um, and then within the private placement memorandum, you'll see the appraisals available, the inspection, the environmental reports, all the due diligence materials are in there. Another one of the great benefits of the Delaware Statutory Trust, we haven't talked about this yet, is the 45-day identification period. So once somebody's deal closes and that $4 million doesn't come to us, it goes to the qualified intermediary. We never touch anybody's money. They have 45 days to identify the property or properties that they're thinking about buying. So sometimes we get people calling us on the 45th day, help, our deal fell through. We can still identify on the 45th day with a Delaware Statutory Trust or several Delaware Statutory Trusts. So that's one of the beauties too. And then, like I said, the debt is usually about 50% loan to value. So generally, that's going to work for people who bring debt to the party. There are Delaware Statutory Trusts that have no debt; it's all cash. So somebody that sold the property and had no debt, they're not. Sometimes there's some benefit to taking on some debt. You get some more depreciation, but those are more detailed conversations that we can have with people about the pros and cons of having more debt. Again, non-recourse, not responsible for it, don't have to apply for it, doesn't go on your balance sheet, not on your credit report. There's just so much flexibility within this tool that allows Jamie and I to really custom tailor a deal like nobody else.
And so a couple things I want to hone in on there a little bit. You mentioned the 45-day holding period, and that's really important. And so if you're someone out there who's considering one of these exchanges, you sell the first property, the cash doesn't come to you, right? You want to engage one of these intermediaries beforehand. The cash goes to the intermediary, and if you don't spend the cash and buy the new property within 45 days, you're not able to defer all the tax. Did
You
I
have to
capture that?
identify the property or properties within 45 days. You have a total of 180 days to close.
I see. Okay.
So the ID period is really where the heart attacks occur.
Right.
So if you don't ID that property in 45 days and get that information to the qualified intermediary, you're out of luck. And what happens a lot of times is people will go out. Let's say they sold a single family home and they want to buy another single family home. And let's say they're on day 20 of the ID period and they ID that property. And then as they're going through the due diligence on that property, and there's the inspection and this, that, and the other thing, and they find out that it needs a new roof and it needs this and it needs that, and the seller isn't going to negotiate, now they got to go start all over again. So a lot of times what we do is we'll use a Delaware Statutory Trust as a backup property. So we'll say to somebody, well, go look for your single family home, but let's get you reserved in a Delaware Statutory Trust in case that doesn't work out. We've got you covered. So it's a tool that's got so many uses for it that it it can reduce the stress a lot that people are going through in this process because it is stressful. People are trying to make decisions in a short period of time.
Yeah, I would concur with you there. I mean, think about all the hoops you have to jump through when you're closing on a real estate transaction. You compare that to a securitized offering where the due diligence has already been done by, a brokerage firm in the first place, and it's a hell of a lot easier to leg into logistically.
Correct.
Now,
And these properties are they're all class A. You might get a class B apartment, which doesn't mean it's not a good apartment. It just means it's a little bit older, maybe 8 years old or something like that. But all the properties are uh, institutional quality property. It's the Prince of Saudi Arabia is going to invest in that, or Harvard Endowment is going to invest in that. Life insurance companies are investing in these kind of properties. They're not secondary properties at all. Might be a Sutter hospital. Uh,
which makes it a slightly different risk profile. They're not exempt from risk. But going back to what we want to see in a DST property is one with a good tenant or tenant base and good leases, and something we can say with a high degree of confidence, we believe this property will perform going forward in the way we think it should. Maybe it won't. There aren't guarantees. The traditional risks of real estate investing apply. However, these are of a certain caliber, managed by professionals, managed by people whose job it is to buy, manage, and sell real estate. It's kind of like allowing the everyday investor to have a family office style approach to real estate investing. If you think about CalPERS, when they invest in real estate, they don't do it themselves. They hire someone to take this money and invest it in real estate for them. Ultra high net worth individuals are the same way. They hire someone to invest their money in real estate for them because these people have their own jobs, right? They have a day job. They're not real estate experts. And the DST industry and the sponsor companies work in the same way. Our clients who have jobs or are retired and don't want another job, they can essentially work with these sponsor companies and let them do all of the real estate investing on their behalf. So it's really passive, is one of the main benefits to our clients, and also managed by people with a lot of experience.
so being that it's a securitized offering, for that convenience, what kind of holding period would be suitable? Because I think of non-traded real estate investment trusts as an analogy that have gotten a real bad rap over the years because a lot of people have gotten burned through that kind of structure. What kind of holding period should you keep in mind if you're considering this, and what do you have to pay to that manager for being in one of these securities?
With the holding period in mind, we do have the benefit of being able to look back at the history of DSTs and say what historically has been the average hold period. And historically, we're looking at about 4 to 7 years. Real estate investments are inherently illiquid, right? You don't put your money in real estate, you don't put the money you want to be able to access quickly into real estate. This is not the money you're going to need next year for your daughter's wedding, or this is not the money that you're going to want to pull from when you're taking a vacation next year, right? So real estate inherently is a long-term investment. What the sponsor company is looking at when deciding how long to hold an asset, I mean, they're making an asset manager decision. How is the property performing and what's going on in the real estate market? And they're going to do ongoing analysis to compare a sale today with what a sale might look like a year from now. So the decision to sell is made by the sponsor company based on their experience and the data, and we don't know exactly when it will be. We can anticipate it will be within the historical averages, but it could be more. It could be up to 10 years. Potentially, it could be longer than that. However, we all know, sponsors know, investors get antsy. They do want the ability to re-strategize and potentially exchange again or not. So they are looking to be mindful to the investors' palette and I think really stay, if they can, within that 4 to 7 year range.
One of the things I might add, Grant, is there are companies like Black Creek and Jones Lang LaSalle that have REITs, private REITs. And sometimes what they'll do is they'll take a property within the REIT and drop it into a Delaware Statutory Trust for a couple of years. And there's contracts that specifically state the timeline. So they then, within 2 to 3 years, that property will go back into the REIT. This is called an UPREIT, IRS 721. When it goes back into the UPREIT, people can just stay in there in perpetuity. And both the Jones Lang LaSalle and the Black Creek REITs are highly diversified, and every property and every lease can be analyzed on their website. But once it goes back into the UPREIT, they have to wait another year, but then they can start taking distributions. So say somebody had $500,000 and they thought, God, we're really going to think we may want to start pulling some money out in 4 years. So we would then suggest either the Jones Lang LaSalle, if they had a deal available, or the Black Creek. Then within 4 years, generally not longer, if they wanted to ask for a $50,000 distribution, they could do that. They're going to have to pay the taxes on it, but they could do that. In the interim, they're going to be getting a check, a distribution check every month, just like they would be within the Delaware Statutory Trust. They'd get a check every month.
If you're in one of these things and the property manager decides to liquidate the property, they have a whole bunch of cash, distribute it back to you as the holder of the securities, you just dump it in another Delaware Statutory Trust, continue kicking down the road?
You'll be able to 1031 exchange into any 1031 exchange eligible property. Investors do tend to call us back up at that point and say they enjoyed the passive nature and they'd like to reinvest the proceeds into a new Delaware Statutory Trust property. They can also say, my child is starting college in Utah and I'd like to buy a rental home in Utah and my son's going to manage it for me. So all the 1031 exchange options will remain available to them when a DST property sells, pursuant to the 1031 exchange tax laws at that time.
Right. And I do want to get into that here in a minute or two. What do managers of these DSTs typically charge to be in them?
That's a great question. And there's two ways that sponsors manage properties. Some sponsors manage the properties themselves, and they'll charge the usual property management fee, 2 to 2.5%. That's all in the private placement memorandum. It's all in the projections. It couldn't be more clear. So some of the sponsors have in-house management. Some of the sponsors, like Cantor Fitzgerald, they hire the best of the best. They'll hire property managers that might be managing 20,000 units across the Southeast or something like that. And again, it's typically 2.5%. But when we give people the projected distribution, it's net of all that. It's net of all the management fees. It's net of the loan payment. It's net to them. So if it's a 5% distribution, that's net of everything. When the properties are sold, the sponsor gets a little slice of the like a little brokerage fee. So when our client gets their money, it's net of all the selling expenses, brokerage fees, and things like that.
Right.
We've talked a lot about the work that goes into bringing a DST to a client, and therefore the convenience to the client of having a pre-vetted and pre-acquired property. The expenses that the sponsor incurred in order to bring that DST to a client, environmental reports, any loan fees, appraisals, those expenses are included in the trust. So our clients are paying for the due diligence that's gone into putting this DST together, and that is a part of the trust that they're buying into. So it is our job to make sure that those expenses are appropriate and in line with typical industry expenses. They're not out of pocket to a client, which is fantastic. They don't have to write a check to the sponsor for having done this appraisal. It's handled through the 1031 exchange. So there are no out of pocket expenses or bills ever for someone who wants to 1031 exchange into a DST property.
And
Yeah.
part of that investment, if you will, goes to, buy the property, but it also goes so that there's some reserves. So there's reserves if the roof needs to be replaced or there's some major issue, there's money in the bank to cover those contingent expenses. So the client's never going to get a phone call and go, oh, we have to replace the roof. You need to send us $10,000. The reserves are already there. When the property sells, typically those reserves are, most of them are still there. That gets distributed back to the investors.
Yeah, yeah. As an investments guy, I consider this an alternative asset class. And
Yeah.
the grouping there is private real estate, rental properties, hedge funds, private equity, venture capital, commodities, that kind of stuff. There's a group of people. There are a lot of people out there these days who are intently focused on broad index based investing at minimum cost. And so you put all your savings at Vanguard and you pay 0.03% for the S&P 500 or the US or global cap weighted index. And that's exceptionally inexpensive to invest in because all they're doing, what the asset manager is doing is they're taking a list of securities and they're buying everything on the list. And then every now and then the list reconstitutes. Some companies are dropped, some are added. They're just doing that, right? And so I think some listeners might hear 2 or 2.5% and say that's just crazy. I'm not paying any of that. You got to understand these are apples and oranges, right? They're managing properties, keeping reserves for maintenance and replacements as you described, and it's a completely different asset class, right? So private equity, venture capital, private real estate, the fee structure has to be totally different based on the economics of what you're investing in. So I don't want people out there listening to this just to totally toss this aside because they hear 2.5%, and maybe a portion of the profits from the conclusion of the deal. That's basically how this space works, right? And yes, they're not, the managers are not doing this for free, but it is mutually beneficial when you think about the tax incentives involved in it. So
Well, if you looked at a private REIT, which is, I mean, not a private REIT, but a public REIT, which is liquid, um, and you probably have, under the appropriate circumstances, recommend public REITs, even Vanguard's REIT index. All those REITs, every property. I mean, if the Prince of Saudi Arabia buys a building in downtown Chicago, somebody's got to manage it. Um, if somebody hires an advisor to manage their stocks and bonds, there's a fee to do that, and it's the same concept. The idea is that you don't have to wake up in the morning and think, oh, I lost a tenant, now I got to go find a tenant, or the apartment A was vacated and it's trashed, or the roof needs to be replaced, or gosh, the water heater broke, I've got to be out of pocket for that. So you're never out of pocket for anything. It's professionally managed, meaning that they have all the technology tools to every day look at the rental market in that particular area and determine what can we charge this potential new tenant for rent. They also, when they buy an apartment, they go in and they look at all the things that can be improved. So maybe it's the bottom line is maybe $1 million. Maybe the bottom line on this apartment in Dallas, Texas, was $1 million last year. But they go in and they can identify by and they do a business plan, and that business plan is part of the private placement memorandum, what they can do to improve the rents. Sometimes you have, unusual circumstances, and you're going to want a professional manager there. Could be, let's just say with COVID, where if somebody couldn't pay the rent, you couldn't evict them. So you're going to want somebody there that can manage all that process. And then when things kind of go back to normal, where you can get back on track with collecting the rents and things like that. So yeah, but people, even people with single family homes hire property managers. They bought a single family home as a rental, and I've done that before. I don't want to manage it. I'll happily pay somebody, 2% or 3% of the rent to manage it, and don't call me when the toilet needs to be fixed. So people do that with there's very few properties that aren't, every property that you look at, whether it's a strip center, those are generally have property managers managing them. It's an expensive part of owning real estate is the management part.
Right, right. So there's been a lot of shifting gears just slightly. There's been a lot of talk about pending tax legislation. Biden over the years has been pretty clear that he doesn't like 1031 exchange. Personally, I think it's not a coincidence that President Trump was heavily invested in real estate and now Biden doesn't like it. I think there's some political strategy to that whole thing. What are you two hearing out there? Do you think the 1031 exchange will be preserved in our tax code? What are you reading in the tea leaves?
So as it's currently being looked at in the House, there are no changes right now to the 1031 exchange tax code. So for the time being, it's not final. We are in the clear. We will be in this position again. We've been in it before and we'll be in it again. In fact, under the Trump administration, there were significant changes to 1031 exchanges as a part of the 2017 Tax Cut and Job Act, and they removed the ability to 1031 exchange personal property. So that was a big hit to people like farmers or business owners who, in addition to having the real property, the real estate itself, they previously were able to 1031 exchange equipment associated with their business or collectibles or art. You can no longer do that. So 1031 exchanges have significantly changed in the past, and they may in the future. I will say it is a common misconception that 1031 exchanges are a loophole for the rich. Most people executing 1031 exchanges are people like our parents, our neighbors, members of our Rotary Club, everyday people. It is not just the ultra rich who are benefiting from this tax code. And the 1031 exchange concept has been around for 100 years. It's rooted in sound logic policy that says a 1031 exchange is a continuous investment. You're not taking any paper gains if you reinvest all the proceeds, and your net position hasn't changed much, therefore you shouldn't be taxed. You don't even have any cash to pay a tax bill if you were given one because all your money is reinvested into another property. So with a little bit of education, we've successfully reminded people on Capitol Hill that the 1031 exchange tax code is sound policy, it makes sense, and it benefits everyday members of America. So we're in the clear for now. but I think we'll find ourselves needing to continue to educate policymakers in the future.
One of the things that I, when you think about real estate investments and you think about, like Jamie said, it's people like us that bought a rental house 5 years ago and now we want to sell it. We don't want to manage it anymore. Maybe it's a $500,000 deal. Maybe it's a $200,000 deal. But when you think about pension funds, life insurance companies that own real estate, and now you do away with the 1031 exchange, you're going to dramatically affect the value of everybody that owns real estate, including the police pension fund, the teacher's pension fund. Everything's going to be impacted. You also do away with lots of jobs, commercial real estate brokers, people like Jamie and I, title and escrow people, loan people, because usually there's a new loan that goes on with this. There are some taxes involved. There's transfer taxes. There's things like that. So there's been a lot of high-level studies done by high-level consulting companies, McKinsey and I can't remember some of the other ones. That Ernst and Young did a big study on it. It isn't going to collect the money that they think it's going to do, and it's going to really create problems. It's going to do more bad than good. Now, could they at some point say you can only do so much in any one year, or could they put a cap on it, like maybe you're capped at $10 million and you pay some tax on the amount over that? That could happen. But Jamie and I have probably been on a half a dozen webinars with high level, with Marcus and Millichap and Ernst and Young and other big companies that are involved in this. And it's like Jamie said, we're safe for now. We're safe for now.
Yeah. Yeah, it seems like it's always going to come up on the chopping block. Nothing is permanent when it comes to taxation.
And because we know that, Patrick and I are prepared to talk through all potential scenarios with our clients and say, what if this change were to happen? How would that impact your life and your investments? And how do we plan for that now? So we know this is an issue we might face again, and we're prepared to bring that possibility into our conversations with our clients when we're helping them make a plan.
Right on. Well, I just to something that's coming to mind now, I should have mentioned earlier, but as we wrap this up today, and Patrick, I cut you off for just a moment, but I am a huge fan of this strategy in general. And one of the things that we often run into at the financial planning practice is people come in with rental properties in any way, shape, or form, and either they're unable or unwilling to raise rents over time. And what happens is you have equity and then you have debt against that equity usually. And my job as a financial planner and an investments guy is to help them evaluate the return or cap rate or whatever you want to call it on that property in a number of different ways. When we leverage our real estate holdings with debt, your net return goes up. And as you pay off that debt, as it amortizes over time, as the value goes up, the denominator in that equation gets bigger and your return goes down. And so this whole thing that we're talking about today, whether it be through Delaware Statutory Trust or 1031 exchanges, is just a hugely beneficial mechanism to swap into a bigger property, maybe with more debt. Yes, there's a little bit more risk there, but preserve the return that you're getting on your investment over time without paying taxes. Because if you don't, the return is just going to go down, 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 down.
You hit the nail on the head, Grant. A lot of times we'll find people that are getting, when they actually look at the true value of the property in today's marketplace, maybe they're getting a 2.5% return. Whereas if they go into a Delaware Statutory Trust, they'd be getting much closer to 4.5 to 5% return, and not have to manage it, and not have to worry about replacing the roof. And then one of the things that Jamie and I think about a lot is we think about the risk, and there's a sequence risk in people selling a property and paying the taxes, and now they put it into the stock market. So let's say they had $1 million, they paid 300,000 in taxes, they got 700 to invest. They invest it in the stock market, and the stock market goes down 20% the next day, or the next month, or 6 months later. So we kind of talk through those things with our clients. What are the alternatives? The idea is that if you've got $1 million to invest versus 700 to invest, what makes more sense? Do you want to have $1 million to invest, or do you want to have 700,000 to invest? And that's a determinant. The other thing that I stress with people, it's not an all or nothing thing. If you've got $1 million, maybe you do want to take $1 million off the table, or 2 million or something like that. Pay the taxes, keep it liquid, whatever. We have to ask those questions. As you know, we have to meet the suitability standards with every client. Even in this situation, if somebody doesn't have any outside liquidity, and we look at their financial statement, which we have to do, we have to bring that up, and that's going to be brought up when we turn our deals into Concord, and they're looking at our deal, and they're looking at people's financial statement, and if they see there's no outside liquidity, they get back to us and say, hey, there's no outside liquidity. Well, it's a 1031 exchange. They don't want to pay taxes. So there's a lot of things that we look at, and just like you do, and what in the position that you're in, there's a lot of moving parts. But at the end of the day, you're 30% ahead typically, versus paying the taxes. And if you just, get a nice steady return over the years, and and you can sleep at night, that's really what the DST is all about.
Right, right. Just to play devil's advocate, there are a lot of circumstances where you may want to raise the basis, and yes, you wind up with 700 grand, but maybe the purpose is to raise the basis from 200 to 700 in the first place, and that could be part of the overall strategy. But as you put it,
Sure.
there's a time and a place for either, and I think more often than not, the best course of action is to kick that can down the road.
And that point is why Patrick and I love to have this conversation, not only with the client, but with the client's other advisors. Bring in the financial advisor or their CPA and or their estate planning lawyer. Let's look comprehensively at their position and decide collaboratively what is the best course of action.
So how do people get a hold of you?
They can call us, or they can email us. Our website is LIRE.
Legacy.
What is our website?
LEGACYIRE.com. LegacyIRE.com. That's Legacy Investment Real Estate. LegacyIRE.com. Jamie at legacy1031exchange.com. That's JAMIE at legacy1031exchange.com. Or Patrick at legacy1031exchange.com. Jamie can also be found at the coffee shop down the street here.
I can be found Tuesdays at the Rotary Club meeting with Grant here.
I thought you meant on Mondays.
No, Tuesdays.
Oh.
On the off days that I make it there myself. That's right. Well, this has been great, guys. I really appreciate you taking the time to come on. This is, I think, an area of the tax code, an area of financial planning that a lot of people can use a little bit of education on. And I can safely say that we've bridged a lot of gaps in today's discussion. So sincerely, thank you for joining me.
You're welcome.
Thanks, Grant.
And what we always advise for clients who own investment real estate, start the conversation early work on a plan. Don't wait until you have a property listed to decide what you're going to do. Call us now. We'll help you understand all of your options, and we'll help you chart a day-to-day path forward that's going to put you in a position where you have a simple and stress-free exchange and end up in investment real estate that really meets all your goals. So call us sooner rather than later.
And I might add, Grant, if we just have another second,
Sure.
this is all Jamie and I do. We don't sell annuities. We don't manage money. This is all we do, work with clients in a 1031 exchange. I don't list and sell properties for people, only people in a 1031 exchange. So we're very focused. We're on top of it. Like I said, Jamie's just finishing up her CCIM. We have so many tools to do analysis. Might also add at some point, we could talk about opportunity zones for those clients that are facing large capital gains, but they don't have real estate, like when they sell a business.
I would love to have you both back on to talk about that specifically, because that's a whole universe, and I want to do the topic justice. I know a little bit about it, not nearly as much as you two, but that would be an excellent topic for our next get together.
All right.
Fair enough.
Thank
All
you.
right. Well, thanks. Thank you both again.
Thank you.
Thanks, Grant.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Be sure to subscribe to the podcast on iTunes, Google Play, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements. And feel free to submit questions to growmoneybusiness.com.